Yes, students, in continuation of the 3 videos of capital structure, in this 4th video, I will be dealing with capital structure Modigliani-Miller approach, which is popularly known as EMM approach or EMM hypothesis. It's a very important model. This model is totally different from David Durant's model. You could see this graph, and at the same time I will explain by way of a problem which is given in Khan and Jane, page number 19.13, illustration 19.3. A problem is given. I will be doing or explaining this problem on the basis of this illustration. There are certain things where the MM hypothesis includes, which is different from the net income and net operating income approach of capital structure. Look into this chart. There are two different firms or companies which are identical in all aspects, that is, in their location, in their business, in their profit making, in their earning capacity, etc. They are identical in all ways. They are homogeneous firms. So this approach could be explained only through a particular situation where there are two firms or homogeneous firms which are identical in all aspects except leverage. Here all aspects identical, you should take very care. That is, on the basis of earnings, both the firms remain same. So I am putting one firm. I told only one difference is on the leverage. What is leverage? Leverage means borrowings made by the company. So one company, I am putting it as L, the company name as L, which is a leveraged company. Means what? They have in the capital structure borrowed capital proportion. And another firm which I am taking is unlevered firm. Means they do not have any borrowed capital. The company is strongly working on the basis of their owned capital. So two firms, identical firms in all respects except leverage, I am explaining here. Look into this situation. Earnings before interest and tax will be given in the question. Earnings before interest and tax for both the firms is rupees 1 lakh. This earnings before interest and tax, as you know, under the net operating income approach and net income approach, that EBIT is nothing but net operating income. So net operating income is same as they are homogeneous firms. Now, from the net operating income, what we do under net income approach, we will deduct interest on borrowings in order to get net income. So we are applying here the first step, what? The net income approach method under the MM hypothesis. So what we are doing, we are deducting the interest. This information will be given in the question. Company has 5 lakh debentures at the rate of 10% interest for the levered firm, where for unlevered firm there is no debt capital at all. So what we are doing, interest on debentures we are deducting. So 1 lakh minus 50,000, we got the net income of levered company 50,000 rupees. Unlevered firm, there is no debt, so no interest, so the net income remains the same. These all assumptions you have to take it here. And next information which is given, I had marked all given information in stars. You see, given information in stars. This given information in stars mentions that it will be given in the question. So EBIT will be given in the question. Borrowing proportion will be given in the question, and KE will be given in the question. This will be the same case in case of net income approach also. What are the things which will be given in the question? EBIT or net operating income, borrowings with the rate of interest, and KE will be given in the question. KE is what? Cost of equity capital. Now you see this situation here. Why we are applying this model? See, from the KE, it is clear that the return for the equity shareholders is very high in case of levered firm. Whereas, in case of unlevered firm, the return to the equity shareholders is less. Obviously, you may be under the assumption that the value of the company will be more in case of levered firm, and unlevered firm the value of the company will be less. Equity shareholders attraction will be less because the percentage of return to the equity shareholders is less. Hence the EBIT is same. We cannot assume the investors attraction from the EBIT because EBIT, earnings before interest and tax, is same for the organization. But here what happens? The KE, return to the equity shareholders, is different. As the optimum capital structure, all models replicate that the return for the levered company will be more and the return for the unlevered company will be less. Here tries to explain that this will not happen for a long run. That is the hypothesis which we are going to study here. In other words, I could say that even though the return of the equity shareholders is very high for the levered firm, when compared with the unlevered firm, investors' attraction will not go continuously to the levered firm. Why it happens? Let us test by using some other assumptions. So what we are going to do here, first we are going to find out the value of the shares of the company. You could see that value of the shares of the company is net income divided by KE. Net income divided by KE. Net income divided by KE, we will get the value of the shares. So 50,000 here, net income is 50,000. 50,000 divided by 16%, we will get value of the shares. Then net income divided by KE for the unlevered firm, we will 1 lakh divided by 12.5%, we will get 8 lakhs. So first we have to find out the value of the shares. Market value of shares we are finding out. Market value of the shares we are finding out here. And no, this step is actually similar to the net income approach. Till this point, the calculation is similar to the net income approach. This is the same what we have done under the net income approach in order to find out the value of shares. Now, value of the debt is also given in the question. For levered firm, 5 lakh debentures is there, but for unlevered firm, there is no debt. See, look into the value of the company. Value of the company, when we take S plus D or S plus B, we could say D or B, S plus B. In case of levered company, value of the company is little bit higher, and in case of unlevered company, the value of the shares, value of the company is little bit lower. That is, here it is 8,12,500 and here it is 8 lakh. Now, we are finding out the KO or overall cost of capital. This also we are doing the same way using net operating income, net income approach. Net operating income divided by V is equal to KO. So, net operating income, what is it? Net operating income is given in the question. That is 1 lakh for levered and unlevered firm. Both we are now taking, and V of the company we know. We get what? Overall cost of capital. Overall cost of capital is little bit lower in case of, there is not much change, 0.123 in case of levered firm, and unlevered firm it is 0.125. Now the debt equity ratio we are just taking. This is extra calculation which you are doing. Debt equity ratio, debt divided by equity, 1.6 for levered firm, and unlevered firm it will be 0, hence there is no debt. Now the second hypothesis what we are taking is that we are looking into the investment pattern of the various investors. Suppose you assume that Mr. X is holding 10% of outstanding share of the levered firm. See, that information will be given in the question. I am putting it star. It's an assumption that X holds 10%. It's X is an investor. He holds 10% of outstanding shares of the levered firm. How do we calculate that? Outstanding shares means market value we have to take into consideration. S value. S value into 10%. 31,250 is the shareholding X is possessing. In other words, Mr. X is holding 31,250 rupees worth of shares. What will be his dividend income? In case of levered firm, it is mentioned, given, K is given, 16%. So, for his 31,250 shareholdings, dividend will be 5,000. This X is keeping, and he is under the assumption that company is having 16% return than the unlevered firm, so that is why he had invested in levered firm. But let us put this assumption that X want to invest the same proportion of holding in unlevered firm. So how do we check that thing? Unlevered firm sales S value is given. So if X want to maintain same 10% of the holding in unlevered firm, it will become market value of unlevered firm into 10% holding. It will become 80,000. So 80,000 is the holding if X want to hold same 10% proportion in unlevered firm. Now, if we want to change his investment, what you have to do? So he already have 31,250 rupees investment here, isn't it? 31,250 balance, 48,750. Again, he want to procure money in order to invest in the unlevered firm. So what he do? He goes to a bank and borrows 50,000. In order to maintain the return, or in order to maintain the same proportion of investment in unlevered firm, he will go to the bank and borrow 50,000. So total his investment now at what will happen? 31,250 existing investment in levered company plus 50,000 additional borrowings. He will have how much? 81,250 investment. This is the situation here. This is the hypothesis we put here. Now, let us check with this 81,250 rupees of investment in unlevered firm, how much he will get the return? Because in unlevered firm, the return is how much? 12.5%. So, 81,250 into 12.5%, he will get a return of 10,156. 10,156. What is the interest you have to pay for borrowed funds? Because borrowed funds already, in the levered company we are paying 10% interest, debt at the rate of 10%. So you have to pay interest for borrowed funds 10%. 10% it will become 5,000. So his return is 10,156.25 from levered firm minus interest on borrowed funds. He will get balance return after meeting the borrowed capital interest. Will get balance return of 5,156. Still 156 excess is there. In other words, even though in levered firm, the return to the equity shareholders K is higher, such investors will shift in the long run to unlevered firm because that funds will become more cheaper. Even after paying the interest of the borrowed funds, X will get a return of 5,156. Look at here, X is X with 31,250 investment, he is getting only 5,000 return. But X, when invested in unlevered firm, the same proportion of 10%, he got a return of 5,156. So what we are trying to know detail in MM hypothesis is that in the long run, the investors will always check whether return in levered firm or unlevered firm is which is higher. Even if they borrow the funds, sometimes in the unlevered firms we may get more return even after meeting the interest. This is what MM hypothesis try to explain. So there is some arbitration process which is taking place, that is buying a security in a place where market price is low and selling it in a place where market price is higher. That is called as MM arbitration theory. That is also explained in the textbook. I had done this problem using Khan and Jane textbook. I will scan all the pages along with my notes and forward it to you so that you will get more knowledge about MM hypothesis. So these are the three models which we have to study under capital structure theories. Here the capital structure theory ends. Next video you could see cost of capital, where our portion ends as per the syllabus. Thank you.